Hi, welcome to our YouTube channel. Our topic for today is how much trading capital should we prepare? I believe many of you have this concern, whether should I prepare more or should I prepare less? This is the topic that we are going to discuss. How much of trading capital should we prepare? Before the end of the session, we are going to answer two very common questions being asked. The first question is, should I constantly pump in money into my trading account? Meaning every month I need to deposit a certain amount to my trading account. Second question constantly being asked is, whenever there's any profit, can I withdraw or not? So these are the two questions that before the end of the session we will answer as well. Those are related to trading capital. Now, before I start, welcome to our YouTube channel. My name is Ting Ting. Please remember to subscribe to our YouTube channel and on your notification bell. Now, before I start, as usual, we need to do a disclaimer. Our content for today is only meant for education purposes. There's no buy or sell call. Now, when it comes to trading capital preparation, we try to define from three broad areas. We categorize in three broad areas. It's easier for you to understand. Now, what are the three broad areas? The first one is your trading capital preparation is insufficient. This is definitely no. Now, insufficient meaning what? For example, let's say your FKLI. One contract FKLI, the margin required is 4,000. So let's say if any of your trading capital preparation is below 4,000, that we categorize as insufficient. So this is the first category. The second category will be sufficient. Just only sufficient. And not only sufficient. Sufficient meaning that, let's say for example, the margin required is 4,000. You prepare 4,000, we categorize as sufficient. But on top of that, we need you to prepare slightly above, meaning some of the traders, they prepare 50% above. Let's say 4,000 requirement, I prepare additional 50%, which is 6,000. This we consider as sufficient only. Yes, you did not hear it wrongly. This we consider as sufficient only. And the last category will be very sufficient. Very sufficient in the sense that what we're trying to say is, for example, if the margin requires 4,000, you prepare at least 3 times or 4 times, then this is considered as very sufficient only. So when it comes to trading capital preparation, please remember insufficient is definitely no. Then sufficient, at least it's not that bad, but if you can, please prepare your trading capital in terms of very sufficient. Now, when it comes to trading capital preparation, we are going to look from the perspective of risk and reward perspective. So meaning that when it comes to capital preparation, how much of capital should we prepare? We can view from two perspectives. One is risk, one is capital. So from risk perspective, what are the areas that we can view? First is the consecutive losses. Later I'm going to explain to you what are the consecutive losses, because sometimes when we trade, sometimes we are going to suffer a consecutive losses before we make any profit. So this is what we categorize as consecutive losses. What should you do? Now, second is your mental state. Whenever you do your trading, do you suffer any emotion issue? So from risk perspective, what kind of things that we can prepare? Now, the third areas will be back testing. Whenever you do any trading, your capital preparation will be based on your back testing results. So what kind of back testing results? Later, we are going to elaborate. And the final one will be leveraged versus unleveraged products. When it comes to preparation of the capital preparation, you need to take into consideration whether the products that you are right now looking at, whether it's a leveraged products or whether it's an unleveraged products. So these will take into consideration how much of capital that you need to prepare. Now let's start with the first one, consecutive losses. Now give you an example. Let's say your initial capital required is 4,500 and you're banking 4,500, exactly banking this amount of money. Now subsequently, your stop loss you set at 10%, which is equivalent to 450. Now let's say, for example, you suffer 5 consecutive losses, only 5 consecutive losses. Sometimes it might be more than that, but let's say, for example, you suffer 5 consecutive losses, which equals to 2,250. Now, what is your balance right now in your trading account? So you take your initial capital, which is 4,500, minus your 5 consecutive losses, which is 2,250. Your balance of capital remaining only 2,250. Now, the next question is, Can you continue to trade your next contract or not? Now, even some of the brokers, they allow you to have 50% of the margin required, then you can trade. Even with that, you once you execute your orders, right, you might suffer a loss, continuous loss again. Then are you going to able to continue to trade or not? So sometimes when you prepare your capital, you need to take into consideration about these consecutive losses that you might suffer. Now, second thing is about mental state. I give you two scenarios. The first scenario is, let's say your capital preparation is 4,500 and your stop loss, you cut loss at 10 points. Let's say this 10 points we refers to FKLI, which is 500. Is it 500? Now, let's say consecutive losses is five times. So your balance, let's say, is 3,250. So for example, your margin requires 3,000 is different now. So from that perspective, the second scenario, your capital is 9,000. Let's say your stop loss is also 10 points. Your consecutive losses is 5 times and your balance is 7,750. So if you compare these two, you will see that this balance is 3,250 compared to 7,750. Which one, your emotion will be more stable? You answer me, I believe you definitely know the answer. Compared to this, you will find that you are more comfortable with 7,750. So let's say, for example, overnight, you also can stand for the gap opening. Let's say, for example, there's any gap opening, you can stand as well. But 3,250, you will be concerned whether you can stand if there's any gap opening or not. And now you might not able to sleep as well. So when it comes to capital preparation, try to take into consideration in terms of your own mental strength, whether can you take it or not, especially if you're holding overnight position or you're holding a position trade. Then from that perspective, you will know how much of capital you need to prepare. Now the third, which is the most important thing, is whenever we prepare capital, the best thing is we base on our historical back-tested results. Meaning that once you back-tested your results, you know that what kind of capitals that you need to prepare with the strategies that you are having right now, you prepare in tandem as well. This will be the best because everything you follow the data and you prepare accordingly. It can't be too wrong. Some of you might challenge saying that, hey, this is all historical data. Would it repeat? Would it have anything worse than that? The answer is definitely yes, but we are saying that at least you have a benchmark. From the benchmark itself, you'll know whether your capital preparation is sufficient or not. So the best thing is you backtest your results. From there, you prepare accordingly. This will be the best. And the final one is when it comes to risk perspective, if you need to consider from two different angles your products, whether it's a leveraged products or whether it's an unleveraged products. Now, what is leverage? For example, leveraged products meaning if you prepare one coin, there's a chance for you to make way more than one coin. Then this is a leveraged products. But don't forget, leveraged products, the disadvantage, also the advantage is if you prepare one coin, there's a chance for you to lose more than one coin. So in short, if you're preparing a leveraged products, your capital preparation definitely need to be higher compared to those unleveraged products. Because unleveraged products, technically you prepare everything. So for leveraged products, you are preparing a fraction of it. Sometimes this fraction is very small. So when you prepare your capital preparation, you need to consider whether is it a leveraged products or whether is it an unleveraged products. Now, if you are going to look from the perspective of return, there are two areas that we need to take into consideration. One is our return target, and the second one is our number of products. The number of products that we are going to invest or we are going to trade in, the capital preparation will be different. Now, the first, the return target. I give you two different scenarios again. One is your capital preparation is 4,500. So let's say, for example, your target profit is 10%, so your profit will be 450. Now, the second scenario is your capital preparation is 45,000. If again the same 10% profit, then your profit will be 4,500. So when let's say, for example, your profit target is 4,500, then your capital preparation definitely need to be higher. If you only prepare 4,500, then your profit will be 450 only. Now remember, this percentage is only meant for reporting. Your reporting will look nice, but whenever you are going to use the money, you need to rely on this RM, definitely the absolute value. So when it comes to capital preparation, if your return target is higher, then your capital preparation need to be higher as well. This is common. Now the last one is the number of products. When it comes to trading or investing, you need to remember that we need to have different types of products. Their characteristics, or what we call as the correlation, will be different to be in one of your portfolio. Because for example, correlation meaning that the relationship, let's say like for example, husband and wife, normally we say that we go for different characters, but we go for same values but different characters. Then we can compensate each other or complement each other advantages or disadvantages. Then we can go even further. We can live together even way longer than that. Now when it comes to the products, whatever products that you're going to put in your portfolio, you also need to take into consideration about this. For example, certain products moving upwards, the other products that in your portfolio might be different direction. So for example, if your stocks, let's say your stocks is pointing towards downside, you can't do anything, because stocks technically you can only buy, you can only make money when the market is uptrend. So in that perspective, let's say for example, if you put in FCPO, which is a very low correlation with your stocks. So let's say if your stock market is dropping, at least you can complement with your FCPO and continue to make money. Second thing, the number of products. Once you increase your number of products, your capital preparation definitely need to be more as well, because you need to cater for different products. That's why your capital preparation would need to be more. Now, before we end, we answer two common questions being asked with our answer. Now, the first question is, should we withdraw our profit? This is the question that commonly being asked. Every time when we put in the capital, subsequently, if we make profit, can we withdraw or not? Now, the first thing, if we are going to discuss from a more human perspective, the answer is yes. But please make sure that whatever we withdraw must be less than whatever that you remain in your account. So let's say, for example, we withdraw 30% from your profit itself, 70% you need to reinvest into your portfolio and grow your portfolio. But at the end of the day, you need to know what to consider is whether what is your objective when you start your trading. I repeat, the statement is, what is your initial objective when you start your trading? Let's say your initial objective is for retirement fund, for education purposes, for your kids. Then along the way, you don't withdraw. You grow until you reach your objective. For example, you reach your retirement fund, or you reach your education fund. If not, you don't withdraw. But if your initial objective is to, let's say for example, every year you make some profit, then you can go for tour, then yes, you can withdraw. But the best is you keep on continue to grow your capital. That would be the best. You keep on reinvest, then you grow your portfolio, then your capital and then your return will follow in tandem. Now, the second question is, how often should we allocate our income as investing and trading capital? Some of you might allocate every month, but you find that every month let's say from your salary itself, you take 10% or 15% and you are going to pump into your trading and investing account. But you notice that the amount is very small and you find that very shy to do that. What you can do is you can accumulate in your own bank account and subsequently one-off, maybe every 6 months or every 1 year, you pump all this amount of money into your trading and investing account. That's it. So this comes to the end of our presentation. Remember to subscribe to our YouTube channel and on your notification bell. Please don't forget to give us a thumbs up, a like, and we are going to see you in our next session. Bye bye.